Net worth. When we talk about wealth, we're talking about net worth. It's the true measure of your financial standing. It is the value of everything you own, your assets, minus everything you owe, your liabilities. Your assets are cash, investments, and home equity. Your liabilities are debts like mortgages, credit card balances, and student loans. It gives you an honest, complete financial snapshot. Tracking it helps you focus on building lasting wealth, not just increasing income. People often confuse high income with high net worth. You can earn a lot, but still have a low net worth if you carry too much debt. Inflation. Next up is the invisible force that eats away at your money. Inflation. Inflation is the rate at which the general cost of goods and services rises, meaning the purchasing power of your currency falls. Simply put, your dollar buys less over time. There is no advantage for consumers, but central banks sometimes aim for low, stable inflation to encourage spending and investment in the economy. The major disadvantage is that it forces your money to work harder. If your savings account is only earning 1% and inflation is 3%, you're effectively losing 2% of your money's value every year. Compound interest. If inflation is the enemy of your money, compound interest is its superhero. Albert Einstein reportedly called it the eighth wonder of the world. Compound interest is interest calculated on the initial principal and on the accumulated interest from previous periods, so you earn interest on your interest. It creates exponential growth. The earlier you start investing, the longer you give the compound effect to supercharge your portfolio. However, it does work against you if you have high-interest debt, like credit cards. Just like it causes your portfolio to grow faster and faster, it can cause your debt to do the same. Diversification. This is the golden rule of risk management. Diversification is the strategy of spreading your investments across various asset classes, like stocks, bonds, and real estate, to minimize the impact if one area performs poorly. The popular saying, "Don't put all your eggs in one basket," holds true. It helps smooth out the natural ups and downs of the market, protecting you from crippling losses in any single sector. However, you limit your potential upside. If you diversify, you won't capture the maximum return if one specific sector explodes, but that's a trade-off for security. Liquidity. Liquidity is all about speed and access. Liquidity describes how easily and quickly an asset can be converted into cash without affecting its market price. Cash is the most liquid asset. A house or a rare piece of art is a liquid. High liquidity is essential for your emergency fund. You need money that is accessible right now to cover unexpected bills or job loss. Generally, the more liquid an asset is, like cash in a basic savings account, the lower the return it offers, ROI or return on investment. Whenever you spend money, whether it's on a stock or a new piece of equipment for a business, you need to calculate your return on investment. ROI is a metric used to measure the profitability of an investment relative to its cost. It's usually expressed as a percentage. It provides a standardized way to compare the performance of totally different assets. You can compare the ROI of a rental property versus a stock portfolio, but it doesn't factor in time. A 20% ROI achieved over 1 year is vastly better than a 20% ROI achieved over 10 years. APY, or annual percentage yield. Look closely at your bank statements for this one. APY. Annual percentage yield, or APY, is the real rate of return earned on an investment or savings account considering the effect of compounding interest. It's the total effective return. It gives you the most accurate picture of how much money you'll truly earn on your savings over a year. Always look for the APY when saving. It can be confused with APR, or annual percentage rate, which is the simple interest rate used for loans and credit cards. Looking only at APR on a savings account will underestimate your returns. Bull market versus bear market. These terms describe the mood of the stock market. A bull market is characterized by rising stock prices, optimism, and strong investor confidence. A bear market is characterized by falling stock prices, pessimism, and negative sentiment. Being able to identify the market trend allows you to adjust your strategy. Bulls love to buy, and smart bears know there are opportunities during a downturn. New investors often panic in a bear market, leading them to sell low, the worst possible move for long-term growth. Capital gains. This is the term you need to know when filing your taxes on investments. A capital gain is the profit you realize when you sell an asset, like a stock, bond, or property, for more than you paid for it. It is the primary way most people grow their wealth through investing. Also, long-term capital gains, assets held for over a year, are often taxed at a lower rate than regular income. You will owe capital gains tax to the government on your profits. If you hold the asset for less than a year, the profit is treated as regular income, which is taxed at a higher rate. Credit score. Your credit score is a 3-digit number representing your creditworthiness, which is how likely you are to repay borrowed money. It's based on your history of borrowing and repaying debt. A high score, typically 750 plus, leads to the lowest possible interest rates on mortgages and car loans, saving you thousands of dollars over time. A low score can lead to loan denials, high interest rates, and even higher insurance premiums, making every aspect of financial life more expensive. Taxable versus tax-advantaged accounts. A taxable account, like a standard brokerage, means you pay taxes on dividends and capital gains every year. Tax-advantaged accounts, like IRAs, 401ks, offer tax breaks such as tax-free growth or contributions. Tax-advantaged accounts allow your money to grow much faster over time because you delay or eliminate the annual tax drag. However, tax-advantaged accounts often have strict contribution limits and penalties for early withdrawal. Fiduciary. A fiduciary is a financial advisor who is legally and ethically required to act in your absolute best interest, placing your needs above their own compensation. Working with a fiduciary gives you a higher level of trust, ensuring they won't recommend products simply because they earn a higher commission. Not all financial advisors are fiduciaries. Many are only held to a lower suitability standard, meaning the recommendation only needs to be suitable, not necessarily the best option for you. Depreciation. Depreciation is the decrease in the value of an asset over time, often due to wear and tear, age, or obsolescence. Think about a new car losing value the moment you drive it off the lot. Businesses and landlords can deduct depreciation from their taxable income, which can lower their tax bill. It represents a real loss of value on consumer goods like a car and must be accounted for when calculating net worth. Equity. Equity is the value of an asset owned after deducting all liabilities against it. It can refer to home equity, home value minus mortgage debt, or stock equity, owning shares in a company. Equity represents the portion of an asset you truly own and is a key driver of personal wealth. Home equity can be borrowed against in an emergency. However, equity is not always liquid. You may need to sell the asset like a house or liquidate shares to realize the cash value of the equity. Principal. The principal is the original amount of money either borrowed in a loan or invested in a savings or investment vehicle. When taking out a loan, paying extra toward the principal reduces the amount of interest you pay over the life of the loan. For loans, high monthly payments that are primarily composed of interest mean you are paying down the principal slowly, which costs you more over time.